Hey, what's going on, savers and investors? I hope you're all having a great Easter Monday. If you're new to the channel, then welcome. My name's Griffin, and in today's video, we're going to be speaking about a topic that I've actually been asked dozens of times over the past couple of months or so, especially during this whole stock market crash of 2020, in parallel to the current currency exchange rate between the Canadian and American dollar being at a 5-year low, which if you aren't aware of right now, one American dollar is worth about $1.40 in Canadian, and even went up to about $1.45 on March 19th, which had not been seen since 2016. Now, generally, the value of the Canadian dollar, as well as the entire Canadian economy for that matter, is typically highly influenced by the value of crude oil on an international level, because crude oil is Canada's largest export in terms of dollar value. If we take a look at this chart right here, this clearly showcases that in 2019, mineral fuels, including oil, was indeed Canada's largest export at 98.4 billion US dollars, representing about 22% of the total exports for the country. Keeping that in mind, current oil prices have tanked since February due to this whole dispute between Saudi Arabia and Russia, and due to this, there is a high level of supply for oil on the international markets, which drives the price per barrel down, and for Canada, that has a huge impact because on an international level, Canada is now less competitive and can sell our barrels of oil at a cheaper price, which has a huge impact on our overall economy and dollar as we're seeing right now. Now, for many Canadian investors, the growing currency exchange gap between CAD and USD has raised the valid concern of whether or not investing in American stocks and funds is a good idea or not. In fact, I've even had many viewers ask me to specifically focus on some more American positions rather than always only focusing on the Canadian market, and this is most likely due to the fact that there's more selection, and for the most part, American companies produce and influence most of our purchasing decisions in our everyday lives, which can make investing in these companies a little bit more tangible. Even though I strongly believe that there is plenty of opportunity to invest in solid companies right here in Canada, I can understand the desire to want to expand your portfolio to American positions, especially for some industries such as, for example, the tech industry, which I'll admit in Canada is severely lacking. So in response to all the questions I've received over the past couple of months or so on whether or not currency exchange should be an important factor to consider when investing in US positions as a Canadian, we're going to be going over 4 concrete scenarios of what to expect and how currency exchange can affect the overall returns on your position. The first thing I'd like to speak about so that everyone is on the same page here is something called currency exposure, because without properly understanding this concept, everything else that we're going to be speaking about in the 4 scenarios is going to be highly confusing, and you might not understand why any of it matters. When investing in foreign securities, it's really important to understand that your exposure to currency fluctuations does not come from the currency in which you are trading that security on a given exchange, but rather from the underlying currency of the company or holding itself. This is primarily relevant for stocks that are dual listed on both a Canadian and an American stock exchange, or for ETFs that track the same underlying index and holdings, such as, for example, VFV or VOO, which are both ETFs that seek to track the S&P 500. So even though the surface level price seems to be different for both funds here, it will accurately match the current conversion rate. In addition to this, it is only the relative success of the underlying currency in which a stock or fund primarily trades in that has an impact on the currency part of your return for an investment. So for example, with VFV, which is a Canadian ETF that actually tracks the S&P 500, well, even though this is a Canadian ETF that trades in Canadian dollars, if the American dollar does better relative to the Canadian dollar, this is going to be positive for your return. Another example we could look at to showcase the effects of currency exposure would be with the company TD Bank, which currently trades on both the New York Stock Exchange and the Toronto Stock Exchange, and on the TSC, which is the company's native currency, it's trading at $60.23, and on the New York Stock Exchange, it is trading at $43.07, which perfectly matches up to the currency conversion. The same would be true for Shopify, Fortis, or any other dual listed security. With this in mind, as a Canadian investor, you're most likely going to be calculating your returns in Canadian dollars, but always remember that for a dual listed position or for an ETF that tracks the same index or underlying assets, whether or not it's traded in Canada Canada or in the United States, any gains whatsoever that you might think you're experiencing due to the currency conversion is merely an illusion, as we're about to see in the following example. Once again, the Toronto Dominion Bank is a Canadian company that primarily trades in Canadian dollars, and it is dual listed on the TSC and the NYSE, as we just looked at. Now, as a Canadian, if you purchase shares of TD on the NYSE in USD, which I'm not sure why you would do that in the first place, but let's say you did, you would not have any exposure to the fluctuations of the US dollar, and this would not impact your investment whatsoever because TD primarily trades in Canadian dollars. Now, for the sake of this example, we'll use round numbers because it's going to make things a lot easier, but the concepts remain entirely untouched and the same. So let's say the Canadian and US dollar were both at par, meaning that one US dollar is worth one Canadian dollars, and you were able to purchase 10 shares of TD at $100 each on the TSC for a total of $1,000 Canadian, and then also 10 shares of TD on the New York Stock Exchange at 100 USD per share for a total investment of 1,000 USD. In this hypothetical example where the currencies were at par, you would currently have the same number of shares and be out of pocket the same amount as well. Now, let's say 1 month later, the Canadian dollar drops in value by 20% in relation to the US dollar, meaning that now one Canadian dollar is only equal to 80 cents USD. And because TD trades in Canadian dollars primarily, even if the value of the shares in Canadian stays untouched at $100 per share, the share price of TD on the New York Stock Exchange would reflect this currency conversion, with the share value dropping to 80 USD, as we saw earlier when comparing dual listed positions that accurately reflect the conversion rate. To continue with the example, the 10 shares of NYSE TD would have taken a 20% loss in value in regards to US dollars, going from 1,000 USD in value to 800 USD. And at this point, you might think, oh man, I just lost 200 bucks. But even though the value is lesser in USD, well, each American dollar is worth more in Canadian dollars, which as a Canadian, if you're hopefully calculating your returns in Canadian dollars, nothing has changed here because the 800 USD is worth 1,000 Canadian, which is what you purchased it for when the price was at par. The same would be true in a vice versa example of if the Canadian dollar would have been worth more than the American dollar and you're calculating your returns in Canadian dollars. The reason why I first and foremost needed to clear up this concept of currency exposure was because I've had some viewers ask me whether or not it would be a good idea to switch between dual listed positions based on the currency conversion rate, or even do the same with funds, for example, VIV and VOO, switch between the two. And as we just saw, this would have no impact whatsoever on your returns, other than the fact that you might be in a worse place than when you started, because you'd be incurring a bid-ask spreads, commission fees, and currency conversion fees. All right, so now that we better understand the fact that the currency exchange only has an impact on the underlying currency of the holding, let's now dive into some concrete example looking over the stock Pepsi, which only trades in US dollars, and we're going to be looking at 4 different scenarios where the price of Pepsi changes and also the currency exchange rate changes. As a baseline for these 4 scenarios, let's say that right now you were to purchase 10 shares of Pepsi at $133.63 a share, which was the price that this stock closed at last Friday. And this is a company, remember, that only trades in USD because it's an American company that is only available to purchase on the NASDAQ. So 10 shares would set you back $1,336.30 in USD at a current CAD value of around $1,864.84. Scenario 1 would be that the value of Pepsi continues to rally up to 150 USD per share, but the fate of the Canadian dollar gets worse and continues to drop down to $1.50 for each American dollar. Scenario 2 would be that the value of Pepsi remains the same, but once again, the value of the Canadian dollar went down to 150 Canadian for each $1 US dollar. Scenario 3 is that the value of Pepsi rises to 150 USD per share, but the Canadian dollar also gains some power here and going up to $1.25 Canadian to each $1 US dollar. And finally, in scenario 4, the value of Pepsi goes down to $115 and the Canadian dollar rises in value to $1.25 Canadian for each $1 US dollar. Starting off in scenario 1, where you had purchased 10 shares of Pepsi for a total out-of-pocket cost of $1,336.30 USD, or $1,864.84 Canadian, which remember is the current conversion rate. If the share price were to rise to 150 USD, this would mean that your total value in USD would rise to $1,500 for a $163.70 USD gain, which would be equal to $2,093.03, which is a $228.19 gain in Canadian dollars. Awesome, right? However, in this scenario, the Canadian dollar continues to lose value relative to the American dollar to the point where 1 USD is now worth $1.50 Canadian. At this conversion rate, if you were to sell your position and go back into Canadian funds, instead of a gain of only $228.19 Canadian at the conversion rate of which you purchased it at, your Pepsi stock at a value of 1,500 USD would now actually be worth 2,250 Canadian for a total gain of $385.18 Canadian without taking into account any conversion fees or currency exchange fees. Due to the fact that Pepsi is an American company and this stock trades in USD, well, as a Canadian, if you were to invest in that company, you would actually benefit if the Canadian dollar loses value in relative terms to the American dollar. In scenario number 2, once again, your baseline cost for the 10 shares of Pepsi was $13.36 USD, or 1,864 Canadian. If the share price remains the same for each share, your total cost and investment value remains the same, meaning you would make no returns on equity pricing. However, if the value of the Canadian dollar were to continue to fall down to a level of $1.50 Canadian for each 1 USD, at this conversion rate, if you were to sell your position and go back into Canadian funds, well, due to the fact that the US dollar is worth more than when you made the purchase, your unchanged 1,336 USD shares would be worth $2,004.45 in Canadian for a total gain of $139.61 Canadian, exclusively based on the fluctuation of the currencies. Moving on now to scenario number 3, this is where the value of Pepsi would rise to 150 USD per share, but the Canadian dollar gradually gets stronger, where it reaches a level of $1.25 Canadian for each 1 USD. Once again, your baseline cost for the 10 shares of Pepsi are $13.36 USD or $18.64 Canadian, but with the rise in value per share of Pepsi, your position would now be worth $1,500 USD. However, due to the fact that the Canadian dollar went up in value, this is actually detrimental to your gains on this position because the relative value is worth less than at the time of purchase. Even though the value of this Pepsi position is $1,500 USD, in Canadian, this would now only be equal to $1,875, meaning your total overall gain would only be $10.16 Canadian. And that's not to mention that with most brokerages, you are going to be paying a premium on conversion of currency and maybe even a commission fee, putting you in the negative on the trade. And finally, in scenario 4, the value of Pepsi goes down to 115 per share and the Canadian dollar rises in value to $1.25 Canadian to each 1 US dollar. This would pretty much be the worst possible combination of events and would translate into a huge loss on both currency conversion and the value of equities. Once again, a baseline cost for the 10 shares $13.36 USD, but with the value of each share dropping to $115, this means your total market value is now $1,150 USD, and when taking into consideration the new conversion rate at $1.25 Canadian per 1 US dollar, this would equal $1,437.50 Canadian for a total loss of $427. All right, so with the current exchange rate being at an extremely high level, what should you do as a Canadian investor and what are some factors to consider? Well, this really comes down to 3 main elements that you're going to want to consider. Number 1 being the future value of the shares that you're looking to purchase and how bullish you are on that company, followed by the currency conversion rate rate and conversion fees that you might be incurring when purchasing American securities with Canadian funds, and then also the future currency conversion between CAD and USD. And from there, it's basically just simple math and a little bit of speculation. First off, if you're looking to invest for the long term in financially solid companies that have great balance sheets, as we like to speak about on this channel, then most likely in the next 5, 10, 15 years, if you're investing in American companies that fit that criteria, the share price is going to go up in value, especially considering the current state of the S&P 500, but we're not going to get into that in today's video. I just want to basically say that over the long run, if you're looking to keep those positions, most likely the returns in equity is going to exceed the potential currency conversion rate. The next factor that you're going to want to consider is the future relative value of the Canadian dollar versus the American dollar over the period of time that you're going to be holding those American positions. And remember, at the beginning of the video, we spoke about the fact that the Canadian dollar and overall Canadian economy is highly influenced by the international price of oil. So over the next 5 to 10 years, do I think that it's likely that the Canadian dollar is going to gain relative value? Most likely yes, but once again, this is relatively speculation. And finally, you'll need to consider what types of conversion fees you're going to be incurring on your transactions when purchasing US securities in Canadian dollars. Most brokerages are going to charge anywhere from 1.5% to even 2% to do this with regular brokerages, and this can represent hundreds if not thousands of dollars in currency conversion fees over the period of time that you're investing. A couple strategies that you could utilize to avoid some of these currency conversion fees would be to place a forex order between CAD and USD in a brokerage account with a broker such as Interactive Brokers, which basically is going to allow you to eliminate all conversion fees, and then you can purchase US securities with that American money that you have in your account. Or you could also use, for example, Questrade, which allows you to essentially borrow US funds with your Canadian funds without incurring an additional fee on top of everything else. Another element that you could consider is to invest in a currency hedged ETF position that trades on the TSX, and this allows you to take advantage of gains in US equities without being exposed to potential losses when and if the Canadian dollar does gain value again, which is highly likely over the next 5 years. For example, the Vanguard ETF VSP is exactly this for an S&P 500 ETF, which right now, since the value of the Canadian dollar is very low, might be a good option to consider. Now, do keep in mind though that with hedged ETFs, you're essentially making a bet that the US dollar is going to weaken in relation to the Canadian dollar. I think that over the next 5 years, this is most likely to happen, but the exact opposite has pretty much been the case historically. So unhedged is usually the way to go. Although if you're buying right now, there is most likely some benefit to this because Canadian dollars are most likely going to get back to that 1.2, 1.3 range in the coming years. With everything that we just spoke about, and I know we covered a lot of information, should you or should you not be fearful of investing in US securities right now with the conversion rate being extremely favorable to the American dollar? And what I would say to this is it really depends on the companies you're looking to invest in and whether or not you think that over the next 5 to 10 years, the value will exceed the Canadian dollar, potentially rallying back up an extra 10 to 15%. If from doing your own calculations and projections, you think that the investment is a good opportunity, then definitely don't be fearful of investing in US stocks. After all, American companies historically have always performed the best typically. However, I do just want you to be aware that currently we're experiencing above average conversion rates due to this whole oil war. So what am I personally doing right now? Well, most of you are aware of the fact that I like to invest more heavily in the Canadian market because I do think there are many opportunities for growth over the coming years in this market. And for this reason, I'd be avoiding all conversion fees and any other sort of fee really. However, I have picked up a couple American positions over the past couple of weeks or so due to the fact that their price was just so incredibly low relative to what I think the actual value of the company is and what the share price is going to be reflecting over the next 5 to 10 years. All right, that pretty well wraps up what I wanted to speak about in today's video. What did you think of this whole rationale and what are you currently doing? Are you investing in US securities or are you focusing more on the Canadian market? Let me know down in the comments. I'd love to answer all your questions and comments. And also, if you enjoyed this video, make sure to smash the like button. It really helps the channel grow. And also, if you want to learn more about investing in the stock market, check out one of these 2 videos that I'm overlaying right here. So on that note, thanks a lot for watching and I'll see you in the next video.